bestseller. And now, here's David Hayes.
Welcome to podcast number 13, 2025, The Final Drive. Of course, that is the metaphor on my football playing and coaching days. Time is ticking. Time is running out. The time to go is now. The 2017 tax cuts, they are set to expire at the end of 2025, giving us the real opportunity to act now and save ourselves from taxes destroying retirement accounts before they go up for good. Today's topic, I'm going to talk about capital gains. Capital gains are different. Capital gains is basically when you own something and it appreciates and you sell it and you have a gain. Now, there's two types of capital gains. You have short-term and you have long-term. Short-term, you don't want those. Short-term capital gains are like ordinary income. So it's just like the interest. It's just like the money you made at your job. It's the money that you made that you pulled out of your IRAs. That's ordinary income. If you can avoid that, that's what you want. You want long-term. Because long-term capital gains, if you hold it for 1 year and sell it, it's treated differently. Now, you can also have a loss. You can also have a long-term loss. Now, if you have a long-term loss, there's only two things you can do with that. One, offset it against another gain, which is a great idea. But if you don't have another gain to offset it, then you have to sit there and let it trickle off on your tax return forever at the tune of $3,000 a year. Now, that $3,000 a year has been the same forever, as long as I can remember. In the 28 years I've been doing this, I cannot remember that long-term losses could bleed off taxes any quicker than $3,000 a year. Don't ask me why. I have no idea. Sometimes rules are rules and they just stick. And this is one that's stuck forever. So if you have a loss, you need to search around for a gain to offset that loss. That's number one. Now, let's get back to the gain because we don't want to talk about losses. We want to talk about gains. What's the difference? Well, under the current tax law, once again, this sunsets and goes back to where it was before. Capital gain taxes, capital gains are marginalized like ordinary taxes are. Remember earlier, we talked about how our tax structure works. You have the first portion of your income that's tax-free, which is your deductions, and then you move into the tax brackets. Then you have a portion taxed at 10%, then a portion taxed at 12 and 22 and 24 and so on. Well, capital gains are kind of the same, except it's 0, 15, and then 20. It's very, very simple. So for most people, if handled correctly, especially in retirement, you could literally have no tax on your capital gains if you handle it correctly. Now, what do I mean by handling it correctly? You have to have different buckets of money to survive. Now, I'm really focused more on the retiree, person that has money that has gains that they have not realized yet. They have money that's in a Roth. They have money that's in the traditional tax-deferred IRAs. They have these different buckets of money, right, that are taxed differently, money that we're paying tax as we go.
Thank you for listening to this podcast. The clock is ticking. Each decision that is made today will put more money into your pocket or leave you worried about your financial future. The time to prepare is now. The time to eliminate risk was yesterday. Let's partner to help those around us to make decisions that empower their financial future. If you would like to book David for a speaking event, please contact CFC at cfci.us. You can purchase his book, 2025 The Final Drive, by going to www.cfci.us and clicking on 2025 The Final Drive.